Really excited about today as we're going to hear some of the insights from our local best-of-breed managers and from right across the risk spectrum of our Nedgroup Investments best-of-breed fund range. Our aim today is really for our managers to discuss some of the topical themes in investment markets to date, and then for them to demonstrate how they are positioning your portfolios or your clients' portfolios in the current environment. My name is Doug Nicol, and I'm joined today by Tumi Greater, and we will be your hosts from Cape Town today as we take you through the Fund Manager workshops. Before I continue, I just would like to acknowledge those who have been impacted by the recent civil unrest and looting that has taken place, particularly in areas such as KwaZulu-Natal and Gauteng, and really we do stand with those who are impacted, which includes some of our colleagues who are listening today. But I think what's really been interesting and exciting and unbelievable to a certain extent is the way South Africans have pulled together during this period, and it's been great to see some of the solidarity amongst our people. After these events, I guess the question is, what has happened to markets? And South African bonds and equities and the rand has remained relatively resolute despite these circumstances. And I guess this is probably more to do with the global investment environment that we find ourselves in, which we've seen continued support from central banks and governments in terms of some of the supportive fiscal and monetary policies. And certainly this has helped calm some of or help continue grow some of market returns over the last quarter. But today, I'm sure we're going to hear our managers talk through some of these themes and talk through where they see markets go into the near future. And we look forward to hearing from each of them later on. Our first speaker today is Dwayne Dippenaar. He's the PM at Laurium Capital and is one of the lead portfolio managers of our recently launched Nedgroup Investments SA Equity Fund. And really this fund is focused exclusively on investing in South African markets and has no offshore exposure in it whatsoever. And we see this as being a key building block in our diversified portfolio for those investors looking for an SA-only focused fund. Laurium have run their strategy, which our fund is based on, since 2014, and they've delivered incredible success over the past 7 years. And we really are excited to have them on board. Dwayne today is going to talk us through the fund's performance during quarter 2. And then he's going to talk through some of his thoughts on Naspers, which is obviously one of the bigger components of the JSE. And then we'll turn it over to some Q&A. So over to you, Dwayne, and look forward to hearing what you have to say.
Good morning, Doug, and thank you for the introduction. Good morning to everyone on the webinar from a chilly Johannesburg. We just examined the fund's performance since inception. You can see the fund's outperformed the benchmark relatively nicely and ranks 16 out of 53 versus our peers if we compare to other SA equity-focused funds. It's done relatively nicely compared to peers. Over a 1-year time frame, the fund has underperformed the benchmark slightly. And this is really because we didn't have holdings in Richmond and Capitec. The holding that we did not have in Capitec was offset by holdings we had in the other banks that performed very nicely. And we also had a relatively large position in British American Tobacco, which has lagged the market. That being said, we still think it looks very attractive. On a year-to-date basis, the fund has outperformed its benchmark, and that was really driven by MTN and Platinum, and offset by a bit of weakness in gold, which has been under pressure in Q2. Just looking at absolute contribution, MTN, you can see, has done very nicely for the fund. We've seen South African property come back and Growthpoint doing nicely for us. And the rest of the positive performance was really a story of insurers and banks. On the downside, Naspers has been under a lot of pressure. We did sell down a position at the end of January, and we thought Tencent was relatively full, but we still have a large position in it. And the rest of the downside really came from precious metals, driven by gold and platinum being under pressure. If we look at the fund's positioning, we still think it's a nicely diversified portfolio. About 25% of the portfolio in global consumer stocks. That's really Naspers, British American Tobacco. decent slug of the fund in banks. We have sold this down slightly, but still think the South African banks look very attractive. Got good exposure to diversified miners, that's BHP and Anglo. Very decent exposures to the PGMs, which we remain very constructive on. We've built up a stake in insurance, which we think looks very attractive and based on a risk-reward basis. And we've also built up a nice stake in healthcare, which we think should perform very nicely after being under pressure due to COVID. An effective look-through exposure, if we look at where the value of the fund sits from a geographic perspective, 42% of the fund is exposed to developed markets, 17% of the fund in emerging markets, and that really once again is through Naspers, and 33% of the fund is exposed to South Africa. So still quite large exposure in South Africa. That being said, it is well underweight where the benchmark is, but we are finding very attractive opportunities in South Africa, with some stocks valuations giving very large margins on safety, even though there are large risks in South Africa. Just examine the top 10 holdings in the fund. Naspers, still a large stake. We've had a much larger position in the past, but it has come down. And right now, we think it's looking very attractive. Good exposure to diversified miners through 6% in Anglo American, 4.5% in BHP Billiton. Decent exposure to British American Tobacco, and MTN remains a large position, even though we have sold it down as it's rallied very strongly. And then good exposure to Platinum through Impala Platinum and Amplats, our preferred picks in that space. And good exposure to the South African bank sector through Absa, Standard Bank, and First Rand. If we just examine the Chinese internet opportunity, there's been a lot of news that's been coming out of China with regard to regulation. We have to understand these large internet platforms collect a huge amount of data on consumers globally, and they have to use that data very responsibly. So what is driving the regulatory change in China? Firstly, the regulators have been very slow, and we've seen a rapid pace of technological change in China. The regulators are really just trying to catch up to that. They're trying to close certain loopholes for regulatory arbitrage. For instance, banks in China need a license and need to be well capitalized to lend to consumers, versus the internet players neither needed a license nor capitalization. And so the regulators are trying to close those loopholes. They're trying to curb monopolistic tendencies. Certain of the large platforms prevented players from selling on multiple platforms and demanded exclusivity, which wasn't healthy for competition. So they want to ensure a level playing field for customers and competitors, and this should result in a healthier internet industry in the long term, which is good. And then, of course, very importantly, security of what is perceived as sensitive data in China. We saw the listing of DD and how the Chinese got very upset about that. And that was really driven by the fact that they were worried that DD would disclose sensitive data to American investors and American authorities. But we've seen the vice versa from the US that's very worried about their data being shared with the Chinese. So this will be a continued sensitive area for both countries. Overall, we believe the regulation is considered and logical and will actually result in a healthier industry going forward, which for the long term is great for internet companies in China. We then look at Tencent, which is 85% of the intrinsic value of Naspers, and obviously the crown jewel of their investment portfolio. It's got the largest online community in China due to its leading market share in multiple platforms, one being QQ, where it has 744 million monthly active users. Weixin, which is the WhatsApp of China, with 1.2 billion monthly active users. And then it's also the leader in multiple other internet platforms, including the largest social network, largest news network, largest video platform, that's Netflix and YouTube of China, largest music platform, literature platform, and online mobile platform. The company can obviously take the data that it collects off all these platforms, examine it, and monetize it over time, which is a very exciting opportunity and also creates a huge moat around Tencent, which we think is very attractive. On top of this, it's based in the largest internet population in the world with strong per capita income growth. growing internet penetration, with China's internet penetration only at 72% versus the US at 87%, a proliferation of cheap smartphones, and a strong 4G and 5G rollout. So smartphone penetration in China at only 71% versus the US at 90% and should grow rapidly. And Tencent's able to use all these platforms it has to identify new areas of the internet that are growing quickly and invest in those areas. And over time, by doing this, it's generated 60% IRRs on its investment portfolio of over 800 companies, of which to date only 60 are listed. So huge opportunity to unlock value there. So we think there's large monetization opportunities for Tencent in new verticals. It's going into payments, wealth products, software as a service, online to offline services, cloud, health, edtech, etc. On top of all this, Tencent is trading at a 19 forward PE ex its associates, which we think looks very attractive compared to its history and peers. We believe it can generate a 5-year earnings CAGR of over 20%, notwithstanding the current regulatory headwinds. So a very attractive company. We look at our positioning of our funds going forward, have large exposure to Tencent and other emerging market internet assets through Naspers, and you're buying it at over 50% discount, which we think looks very attractive. Good position in British American Tobacco, trading an 8 forward PE, an 8% pound sterling dividend yield, which we think more than prices in regulatory issues there. In the South African financial space, the banks, which still look attractive, good balance sheets, and we've seen provisions unwinding quicker than expected. Good exposure to the insurers, where we have good feel for the back books, good free cash flow, and we know their provisions they're well provided for persistency, mortality. They might have to take more provisions, but won't change our fair values that much. The healthcare stocks, we have decent exposure there. They're trading at 8 EV/EBITDAs, and as capacity utilization picks up, earnings should come back. And select resource exposure through the diversifieds, a little more cautious on bulk commodities like iron ore, but still very constructive on the platinum group metals, playing into the greening of their economy and no new supply coming online in the medium term. In summary, the global fiscal and monetary stimulus remains supportive for global and South African markets. We've seen strong global growth, which is positive for EM risk assets, including South African listed stocks. We've seen slow but steady structural change in South Africa, which is great. We are finding great opportunities in the local markets from a valuation perspective. Something we watch carefully is the threat of inflation based on stimulus and global increase in monetary supply. And for us to really become more bullish on South Africa in the longer term, we'd have to see more structural change and the acceleration of that structural change. On that note, I'm going to hand back to Doug.
Thanks, Dwayne. Appreciate your insights. Certainly on Naspers, Tencent is certainly, given its scale and I guess its growing relevance to the Chinese government in terms of collecting information on the population, it certainly seems to be aligned with investors' interests.